Welcome to Bloomberg ETF IQ. I'm Scarlett Fu.
And I'm Katie Greifeld. And Scarlett, welcome to the second quarter.
The first day of the second quarter after 2 straight quarters of double-digit gains. What happens next?
We are going to find out. But before we do, let's get to the biggest stories right now in the more than $12 trillion global ETF industry. And we start with Goldman, charting a path to become one of the top 5 model portfolio providers. That's a tongue twister. A booming corner of money management.
So our first guest, the woman who is hoping to achieve that goal, Alexandra Wilson-Elizondo of Goldman Sachs, who has a plan to outgrow rivals.
And we're also going to look into Top Gun companies with the highest investment quality. We're going to do that with Matthew Tuttle. He is the CEO and the CIO of Tuttle Capital Management. But sadly, Eric Balchunas is off this week, so I'll be looking at the flows in his stead. Let's first start with, of course, the inflows, where money was moving into over the past week. And right up at the top, you have IVV there. You also have the Qs taking in $2.6 billion to, of course, the nearly $17 billion that went into IVV. Of course, it was the final week of the quarter, so take these numbers with a grain of salt. You also had VU coming in there as well as AGG. So a lot of these big passive index tracking funds taking in a lot of money. On the other side, though, if you take a look at where money exited over the past week, you do have SPY up at the top there, losing nearly $4 billion. Again, end of the quarter, don't know how much to read into that. You do have LQD up there as well. That is an investment grade ETF tracking the credit market, losing about $1.2 billion, and money continuing to come out of GBTC, losing another $1.1 billion in the week just passed. All told, GBTC now sitting on outflows of nearly $15 billion. But let's talk about model portfolios. They tend to be in the background of a lot of our conversations about flows. And in terms of how big model portfolios have gotten, there's a lot of different estimates out there. Right now, this one is from Broadridge, who estimated that at the end of last year, model portfolios held $5.1 trillion. That would be a record. Of course, model portfolios, they basically package together funds and then they're sold to financial advisors and the like. And as you can tell from the chart behind me, Scarlett, they are very popular.
They're definitely increasing in popularity. So let's bring in our first guest right now, Alexandra Wilson-Elizondo. She is co-CIO of the multi-asset solutions business over at Goldman Sachs. Alexandra, thank you so much for joining us today.
Thank you so much for having me.
So Katie told us about the numbers for model portfolios. Why are model portfolios having a moment, and how do ETFs play into this opportunity?
So model portfolios are really born of 2 very important structural shifts that happen in the market. The first is ETFs and the ability to have liquidity and transparency and same-day type pricing. They became very important building blocks for asset allocators. The second that's really important here is that you have advisors, especially post-global financial crisis, that are looking to spend more time on how do we do wealth planning? How do we holistically look at our client base? And how can I outsource the ecosystem of investing to people who do this for a living day to day like ourselves?
And it's really interesting, again, to focus on the structures used within the model portfolio. It's increasingly becoming an ETF story. There are, of course, mutual funds heavily used in model portfolios. But why has the shift been more towards ETFs?
It goes back a lot to that liquidity and transparency and execution. That said, the concept of a hybrid model portfolio is really gaining traction. I would outline hybrid portfolios to be 3 different styles. One is the mix of passive and active within a model portfolio, and that can be an ETF structure. Then the other type is when you put mutual funds and ETFs together. And that is actually growing. So the marginal dollar that came into model portfolios went towards hybrids rather than just traditional indexed ETF structure.
So whenever we talk about the growth of the ETF industry, it's usually at the expense of mutual funds. Why is it a good combination to have both ETFs and mutual funds? What do mutual funds do that ETFs can't do in a model portfolio?
So going back to one of your original questions, and I want to make sure that I answer because it's really important, is, what we're trying to do for the financial advisor community is give that same institutional quality investing to the retail investor that we do to our large institutions like pension funds. And in some of the active product that we manage, we can have some really bespoke solutions. So for example, we offer out an interest rate strategy option that gives you access to levered rates, but you also don't have the same exposure if rates continue to go upwards. So giving that in an active format to some of our clients has been it's really helpful. And you don't need to be a retail investor or institutional investor to want that.
And let's talk about the leaderboard here, because when it comes to who has the biggest model portfolios, BlackRock is usually at the top of the list for asset managers, estimated around $100 billion there. Goldman Sachs estimated to be about in 9th place or so. You told me a couple of weeks ago you want to be top 5. How do you break into the top 5? What's the game plan?
So the game plan is actually quite simple. One is that the market is just growing at an annual rate that's it's overwhelming. So something north of 20%. And so you just have to simply outgrow your competitors in order to be able to go into that sphere. But going back to our heritage, so within the multi-asset solutions team, we're the #1 OCIO provider in the United States, and that's for the large institutional client base. We're taking that same exact brand and structure and delivering it out for our retail clients and the financial advisors. And so really just having that, data infrastructure, that ecosystem of investing. So not just delivering, these are our trades, but here's why. And here's market insights on the weekly and even sometimes in the daily, given there can be instances of volatility.
So something else, of course, you're looking at is the options of the different ETFs that are available to you. The ETF industry continues to explode. There were 530 launches last year, 73% of which were active. What's the read for this year, and what categories are the most in demand right now?
Yeah, so even when you look at our own launches within Goldman Sachs Asset Management, 3 out of the 5 we launched in Q4 were active. So there's clearly a strong trend in that direction. But active is a little bit nuanced. So when we say that it could be a solutions like income or buffered vol or things of that nature, that also falls into active. Mm-hmm. And we think that trend will continue. And it's really going to be a lot about adoption of some of these platforms to be able to handle and digest active ETFs. And it's just like when ETFs first got to the marketplace, it takes time for people to get used to it. We do think that trend will continue and be very important within the model portfolio business.
I have a little bit of an existential question, and that is why there is still so much demand for active, both issuers looking to launch active products, but also from investors as well, because it was kind of easy to explain that desire in 2022 when it felt like markets were falling down. But now you have the S&P 500, 2 quarters of double-digit gains. It feels like if you just sit and SPY right now, you do pretty well. Why do you still think that there's still this demand for actively managed products among investors right now?
So if you do look at last year, it's for sure the truth that active was, it was a difficult environment for active managers. That wasn't the case for the first quarter of this year. And you're really starting to see some bifurcation amongst names and sectors that's coming back. And that's, we think, is born out of we're just getting out of the, the quantitative easing environment where everybody's going to win. And so as you start to get to a macro environment, which gets a little bit more difficult, we do think that having that active management into your portfolio is going to be important. If you look at the space like the credit markets, for example, you're starting to see some single names experience some stress. Mm-hmm. And it's going to be, important, especially in a fixed income structure where they're debt cap weighted indices, that you have a manager that's actually very thoughtful around, oh, I want to own this name, I don't want to own this name.
Right, who can make that distinction.
Yes.
Investors have gotten pretty used to months of 5% plus returns in just their high yield savings accounts. Everyone likes looking at that number grow. How has that affected their investment preferences, whether it's the products they choose or the expectations that they now have?
So we did see a tremendous amount of inflow into the short duration money market type product last year, just given you could get so much on the risk-free rate. Now what you're starting to see, and you've even reported on it yourselves, is some of the outflows from the shorter duration into more intermediate parts of the curve. That's a reflection on duration has a better portfolio construction value at this point, but also you want to lock in interest rates before they start to go down. Markets move too fast and you can't get into them anymore.
So maybe we're starting to see that migration out of cash into some longer duration assets. Unfortunately, got to leave it there. Really enjoyed this conversation. Of course, that is Alexandra Wilson-Elizondo of Goldman Sachs. Now coming up, as we were just talking about, active ETFs, they're making a comeback, particularly in emerging markets, as traders, of course, lured back in there. We'll discuss next. This is ETF IQ on Bloomberg. Welcome back to Bloomberg ETF IQ. I'm Katie Greifeld. Time now for the ETF brief, where I walk you through the trends and the stories that caught my eye in the ETF industry. And we start, of course, with this Invesco Commodity ETF, the ticker there, PDBC. This is interesting because we've all been following what's going on in cocoa, which, of course, has absolutely skyrocketed over the past month. This ETF tracks a basket of commodities but doesn't track cocoa, and that's why I thought it was interesting, because even though we're below the peaks that we saw in October, the prices started to move up. Of course, we're talking about sugar, corn, soybeans, etc. So commodities broadly rallying over the past month or so outside of cocoa. And let's also talk about outside of the U.S. Of course, I can be a little U.S. focused, but you take a look at the European market, and similar to the U.S., it's also dominated by BlackRock. BlackRock controlling about 44% of the European ETF market, bigger lead than it has over in the U.S. So a lot of issuers, as you can see there, fighting for second place. Let's also talk about EM. Again, continuing our non-U.S. focus. In the U.S., we talk about this big demand for active ETFs, and it's the same thing if you take a look at actively managed EM ETFs. Even though they make up about 5% of the total assets in the category, it's taking in over 1/3 of total EM ETF flows overall. So big demand there, too, when it comes to emerging markets.
All right, let's continue this conversation now and bring in Bloomberg's Carolina Wilson for more on the emerging markets. And as Katie was just mentioning, there's a lot of interest now in active ETFs. How's that playing out in the world of EM from where you sit?
So I think Katie highlighted a super important data point. I like to tell people to think of a pie chart. And only 5%, it's such a tiny sliver of emerging market ETF assets are in that actively managed category, and yet they're bringing in so much fresh cash. 2024 has really been heralded as sort of the year for EM, and EM is going to make a comeback, and you really see investors sort of looking to add in that exposure, and ETFs have been a sort of interesting and convenient way to do that. Of course, you see this active versus passive sort of battle humming in the background, and you are seeing the active managers sort of bringing in cash, because investors just don't want that baked-in forced 30% exposure to China, which is what you're going to get in a broad-based passive EM vehicle. And so having an active manager is going to give you some flexibility and optionality in that country exposure, and maybe give you a bit more exposure to some of the other bright spots like India or some of the big country names that are driving that AI sort of phenomenon and boost. So it's also bringing in product issuers. So since the beginning of 2023, about 27 new EM ETFs have launched, and 18 of those have been actively managed. So product issuers are taking note, and they're seeing the demand, and they're trying to bring some more tools to market.
EM ex China. I mean, how many times have we heard that phrase over the past couple years? So when it comes to pursuing that type of strategy, basically stripping out China from your EM allocation, do you need an active manager to do that? Because I imagine that exists in plenty of passive products at this point.
EM ex China has been something that we have not stopped writing about, because it's been such a huge, massive trend. And so the big heavyweight there is EMXC, that ticker, and it's actually a passively managed strategy. It's going to take broad EM and it's going to strip out China. What's interesting here, and this is a cool data point, if you strip out EMXC flows from that flows analysis that you were showing at the beginning of the segment, the amount of cash that's going into actively managed funds in EM ETFs goes from just about 35% to 75%. So it's really still showing that super strong pull into active, but it's also highlighting that overall investors want their EM exposure to look a little different than it traditionally has. EM ex China is a really popular way to do that, and actively managed is also becoming a popular way.
You profiled a couple of fund managers and ETFs that are investing in EM and, of course, actively. Yet, I remember one of them did invest in China, just not in the way that you would expect them to in a passive fund. Explain how he's doing that.
Totally. So a lot of investors still tell us that although they want their EM exposure to look a little different than it traditionally does, they still want some China exposure. And so there has to be a tool to sort of address all these different kinds of investors. We spoke to a retail investor who said, EM ETFs are actually like my first foray into emerging markets exposure, and I'm going to use an ETF and an actively managed one because I feel like I'm trusting an active manager to make those decisions for me. But what if China rebounds? I don't want a zero allocation to Chinese equities. And so having a fund that can sort of make those tweaks and tilts is really appealing to some traders.
All right, Bloomberg's Carolina Wilson. Thank you so much. Carolina, of course, the czar for all things emerging markets here at Bloomberg. Now, still ahead, we are going to drill down into Top Gun companies with Matt Tuttle of Tuttle Capital Management. And after almost 3 months on the market, U.S. spot Bitcoin ETFs, we haven't managed to talk about it until now, are still reaching new heights. Here's what Mike Novogratz had to say about the rise in the digital currency.
So it's been a monster rally. That rally was mostly fueled by adoption, right? With the ETF, it made it very easy for people in the U.S., institutions and the wealth channel, most importantly, to access Bitcoin for the first time.
This is Bloomberg ETF IQ. I'm Scarlett Fu along with Katie Greifeld.
And it's time for today's drill down, where we focus on one ETF. And in the hot seat today, we have BWTG. This is the Brendan Wood Top Gun ETF. So Brendan Wood, it's this Canadian research firm that was founded in the 70s. And basically, they go out, they talk to a lot of money managers and talk to them about their holdings and their convictions. And this is one of the things that has resulted from that. Of course, this ETF, it holds about 20 to 30 holdings. It was only launched last November. It has pretty small assets. We're talking under $5 million, expense ratio of 98 basis points. But let's take a look at the holdings. They're pretty interesting here. Again, it's a small portfolio, pretty concentrated. Up at the top, you do have NVIDIA, of course, but it really spans industries, which is interesting to me because in addition to NVIDIA, you have the likes of ASML, you also have CrowdStrike, you go down the list, you do have Amazon, but then you have some financials as well, the likes of JP Morgan Chase. And again, it's recent, it's new, but let's take a look at the performance because so far since November, it's been pretty impressive. Total return up about 27%, of course, since the start of November. You compare that to SPY, the S&P 500, they're up about 21% on a total return basis in that time. Scarlett, it is very hard to beat the S&P 500, but so far, this ETF has managed to do it.
All right, so let's figure out what is involved in this ETF and how it works. And joining us now is Matthew Tuttle. He is CEO and CIO of Tuttle Capital Management. Matt, great to see you here in studio.
Thank you.
I get Top Gun because it's best of the best, like in the movie. But,
exactly.
And Katie kind of mentioned this, but can you tell us who or what is Brendan Wood? Because I've never heard of them, but they sound like they're going to give the best journalists a run for their money.
They are. So Brendan Wood, like you said, they're a Canadian company, and they do consultations with thousands of top money managers, thousands of top financial advisors, sell-side analysts. And they get into a lot of stuff about companies, but one of the main things they get to from the standpoint of this ETF is what's your commitment to own certain stocks over the next year. And when you're asking thousands of people that, you get a lot of companies that get named a lot. And then that's what makes up the ETF. It's the top 25 companies that these people have the highest commitment to own over the next year.
So high conviction. This is basically like a conviction list, so to speak. And I guess for that reason, it doesn't necessarily, it's not concentrated in one industry. It really feels like it's around the world here.
Well, exactly. And, you know, again, they're doing thousands of interviews. So it's not everybody saying NVIDIA, obviously. It's a lot of people saying NVIDIA. But, you know, you've got names like TransDigm in there, which is a name that, you know, most people wouldn't have heard of. You've got Royal Bank of Canada, which is a name you wouldn't have thought. And interestingly, what you don't have is you don't have Apple and Tesla. And you haven't had those at all because the top kind of institutional guys have been waning in their interests on those names.
Well, also what the fund doesn't have right now is Adobe. It was removed from the Top Gun list, and that's partly because of the issues it's had with its M&A and that kind of falling apart. But there's a lot of interest in it insofar as it's got exposure to AI. What did Brendan Wood learn about Adobe?
So again, in their talks with these money managers, they're seeing conviction might be going up in a name or it might be going down in a name. So Adobe's the only name they've removed in the portfolio, and they did that before it went down like 15%, because what they were seeing is money managers were lessening their interest in Adobe because the smart money saw what was coming and wasn't blinded by, oh, AI, we got to buy AI.
I mean, could you look at this fund and say, basically, this is going to be a momentum play? If you're, talking about the highest conviction, what people own and are most excited to own, are you just chasing momentum here?
So not in the traditional way you look at momentum where, hey, this is going up, we're going to buy it. Because a lot of these names you'll find might not be going up, but you're seeing a lot of institutional money managers starting to look at it, starting to like it, starting to buy it. And on the other hand, you might be seeing names that are the opposite. They're going up, but the institutions are like, we're not really interested in this so much anymore.
So we pay a lot of attention to those 13F filings in which big money managers talk about what they own, and everyone pours through them and tries to figure out, okay, that's what I want to buy because Warren Buffett's buying it. How is this different from that?
So that's the cool thing about this. And I mean, I love 13F filings. You get to see, all right, Stephen Cohen, 45 days ago owned a bunch of Apple. But what that doesn't tell you is why he bought it. Does he still own it? He might be short it. What Brendan Wood is finding out is, well, you know what? Stephen Cohen's got commitment to buy Apple going forward. To me, that's way more valuable, knowing what money managers are going to do in the future versus what they did in the past and might still not have.
And Matt, just over a minute left with you, but you mentioned that, Brendan Wood does thousands of interviews. So do Scarlett and I, and not everyone wants to talk to us. And I guess my question is, why do these money managers talk to Brendan Wood about what they own?
So their reports, to use a technical term, are really cool. I mean, they get all sorts
really
of
cool?
data
Yeah,
about,
come on.
well, no, I mean, you guys are too.
We're working on it.
They get all sorts of data about companies that the money managers get. And their reports are not public. Every once in a while, they'll let me have a couple, and I send them out to people on like Twitter and stuff. And I mean, the data they get on these companies is amazing. So you do the survey, you get access to the data.
Interesting. So if you tell them, you give them your secrets, they'll give you some secrets back.
Exactly.
All right. I get it. Matt Tuttle, it is always so fun to speak to you. Of course, that is Matthew Tuttle of Tuttle Capital Management. And if you just can't get enough of ETFs and you really miss Eric Balchunas, a reminder, you can listen to Eric and Joel Weber on Trillions. It, of course, is their podcast that covers the industry, but sadly, that does it for Bloomberg ETF IQ. For now, I'm Scarlett Fu. No, I'm not. I'm Katie Greifeld. Scarlett Fu is directly.
That's okay. You could be Scarlett Fu today. Yeah.
That would be a dream come true. In any case, this is Bloomberg.